Good evening, everybody. Hope everybody's having a nice summer evening. Tonight we've got the great pleasure of having Jeff Tompkins back with us. He always gets very good reviews, so he's going to be showing us some techniques using RSI and a few other indicators. So with that, Jeff, welcome back. We're anxious to see your information.
Thanks, Stephen. Thanks for having me. Great to be here as always. Welcome to everybody. Looks like we got a nice crowd on a Thursday evening. So one more trading day in the week, and it's a big one. We've got Jerome Powell speaking tomorrow morning, so we'll see what happens there. It's going to be a volatile day, I think, but been a volatile year, right? It's been a tricky year to navigate in terms of markets, and I'm here tonight to help make that easier for you guys. So we're going to talk about the secret to beating the market using relative strength. So this is a bit of a twist on the typical relative strength. If you guys are familiar with the RSI indicator, it's a new and improved way to use relative strength in the markets, and it is very effective at finding opportunities in a multitude of market conditions. So whether we're in a bear market or a flat market or a bull market, this is a really great technique that I think you guys are going to get a lot out of. So let's go ahead and dig on in. All right. Hopefully you guys could see that okay. It was a little choppy on my end, but you'll find out here shortly why it's relevant. It's the margin of victory being relatively small for a great deal of success. I hope it came through smoothly on your end. It's a great message, and it's actually from a really well-known book called, I believe the book's called 212 Degrees. But it's going to be kind of a theme of our topic tonight, and you'll see again here shortly it'll become clear to you why that's relevant. There's a very small degree of, or margin, I should say, between second place and first place, or failure and success, and that will tie into the relevance and importance of relative strength as it applies to the markets, and again will be the theme of our time together tonight. So give you a little bit of background on myself. Probably some of you were on past events where I was a guest speaker for Stephen, but if you weren't, I want to give you a little bit of background. I have 23 years of experience trading the stock options and futures markets. Received my professional training as an intern at the trade desk at Morgan Stanley. I've founded Altos Trading, so I'm the chief investment strategist at Altos Trading. We currently have over 60,000 members in over 100 countries across the globe, so we have very diverse membership. and a diverse group of traders that trade all different strategies and systems and methodologies, and so I'm going to share some of those with you tonight, and what's been working very well for our members, particularly in this in this market that we're in now, which has demonstrated unusual increased volatility, and really since the Corona crash back in early 2020, we've seen some significant choppiness in the market that wasn't typical prior to 2020. Of course, that was at the tail end of this incredible, secular bull market, and so it kind of caught a lot of people off guard, right? And so again, we're here tonight to manage these types of situations, to trade and invest through them successfully, and to come out ahead. And I'm also a hedge fund manager at Altos Capital, so I do manage money for my clients. And most of the methodologies I share on my educational events are actual techniques that I use in my hedge fund. So it's a kind of a unique opportunity to gain an inside look into how hedge funds operate, some of the strategies they use, etc. And I'm also the founder and manager of some of the top performing options and stock alert services on the market. And I'm going to share some of those with you tonight and some of the results that we've seen. So before we get into that, read you a quick disclaimer. Trading securities and options involves risk. Prior to buying or selling an option, an investor must receive a copy of characteristics and risks of standardized options. We're going to talk a little bit of options tonight, but not a lot. It's mostly going to be equities and ETF space. And of course, we do need a broker to trade securities and options and must meet suitability requirements. Past results are not necessarily indicative of future performance. We will look at some performance figures, some based on hypothetical results, some based on actual research that we've done and sent to our members. But of course, due to the time-critical nature of trading, brokerage fees, and activity of other subscribers, we don't guarantee that anyone will mirror the performance shared in this educational presentation. But performance are based on trades users could enter based on the trade signals and the system that I'm going to teach you guys tonight. So by the end of our session together, and we'll spend about an hour or so together, you'll discover how to gain an extra 1 degree trading edge that can put you ahead of some of the best traders and investors in the world. And I mean that with the utmost sincerity. It's very difficult to beat the S&P 500 index. In fact, I think the statistic, if you look at across the whole range of professional money managers, hedge funds, institutions, fewer than 1% of professional traders or investors beat the S&P 500 index. So it's not easy to do, but it's possible. And you really do need an edge, and it doesn't take a big edge. It could be a relatively nominal edge, but you need some degree of edge to gain alpha over the S&P. So whether you're just starting out or you're a seasoned pro, this is really must-have information for today's markets, especially as we're in this wild world of volatility and uncertainty. So the reason I shared that video at the start of our session and the 212 degree difference, because it tied to the edge that we need to identify opportunities in the market. There's so many of them. There's a lot to weed through, and ultimately we need to hone those down into the best that we can find that are appropriate for the current market conditions. And that's where the 212 degree difference comes in. And I think it's a great analogy because at 211 degrees, water's hot, right? But it's still standing still. It's not doing much, and it can be related to a stock before it takes off. So a lot of times you'll notice that stocks, might be drifting down or in a steep sell-off, or even drifting sideways and just not doing a whole lot. Most of the time, they're in one of those categories. They're not, in a parabolic uptrend all the time. That would make things much easier on us, but it's not reality. So when we look at this analogy, as the temperature rises 1 degree, right? So it's going from 211 degrees to 212 degrees. The water starts to boil, and something interesting happens. It creates steam that can power a locomotive train, right? So a 1 degree difference. At 211, it can't do anything to make a locomotive train move. But at 212, it creates steam, and that steam is powerful enough to move a train at a very high speed. Pretty incredible. And it makes all the difference. 1 degree, and it's like, as an analogy again, when a stock starts to outperform a major benchmark index or sector and then skyrockets. So you may see a stock not doing a whole lot. It might be drifting sideways. It might just be, sitting there not doing anything. While, let's say, the S&P or the NASDAQ is in a strong bull market. Have you ever noticed that? Have you ever bought a stock and the market's going up, but your stock maybe goes the opposite way. It goes down, or it doesn't do anything. You're thinking, well, why is my stock not moving up when the rest of the market is? Right? You'll find out. So typically, people will use what's called the Relative Strength Index, or the RSI, to gauge strength of a security. Right? And it's interesting that they call it relative, because although it is relative, it's not really relative to anything else. It's relative to itself, and I'll explain that. So this is the common indicator that's used to gauge strength and momentum of a stock. So it's basically a technical indicator, if you're not familiar with it, that's used in technical analysis that measures the magnitude of recent price changes to evaluate whether a stock, or any security really, it could be used for futures, forex, is overbought or oversold, right? Now, on your chart, and we're going to look at some charts together tonight, you'll see it's displayed as an oscillator. So it's basically a line graph, and it's bounded. So it's what's referred to as a bounded oscillator. It has a maximum and a minimum. So it can have a reading from 0 to 100. And it's unusual it would reach either of those, either the max or the min. But it's a bounded oscillator, so it can't go past 100 and it can't go past 0. It's been around a long time, and it's actually really widely used. So J. Wells Wilder developed it and introduced it in his book, New Concepts in Technical Trading Systems, which is a great book if you haven't read it, back in the 70s. Now, it's been around a long time. It's commonly used. In fact, it's commonly used among institutional traders to gauge strength of a security. But there's some problems with it. We're going to get into those. But before we do that, let's talk about the way that it's used and how it's interpreted. So traditionally, the RSI is interpreted or used as an overbought, oversold indicator. So if there's a reading or a value above 70, that would indicate that the security is becoming overbought or overvalued. And for that reason, you would expect it might be primed for a trend reversal or a corrective pullback. An RSI reading of 30 or below indicates an oversold or undervalued condition. So that might be a time where you may look at buying the security. But as I mentioned, there's a couple problems. So here's problem number one. Stocks can remain overbought or oversold for extended periods of time. So it doesn't make a lot of sense to use this as a standalone overbought or oversold indicator, because have you ever, if you've used the RSI, you probably encountered this, but whether you've used the RSI or another indicator or methodology, have you ever bought a stock that was going down and you thought, well, this stock's oversold, it's got to go back up, but then it kept going down? Or maybe you bought a stock and it was in a strong uptrend and you thought, well, this thing is really run, I'm making some good money on it, I better get out of it because it's going to pull back. And then it kept going up. I'll raise my hand first. I've done that plenty of times. And it's frustrating, right? So it's that old John Maynard Keynes saying, the markets can remain irrational longer than we can remain solvent. Right? So markets can do what they want for as long as they want. And we don't have unlimited capital to ride those out typically, those situations. So that's one problem. And we'll go through this and look at it on a chart to visualize it. So this is a chart of Tesla, right? And so I've got the RSI indicator plotted at the bottom. And you'll notice that in mid to late October to mid to late November, the RSI was, prior to that, slowly creeping up, right? telling us that the stock was starting to become overbought. And then it passes the 70 level, so now it's in well overbought territory, bumping up against the 80 to 90 level. So Tesla's overbought. It's got to pull back, right? Same thing in December and January, right? RSI saying this stock is way overbought. We're getting readings above 70 for almost a couple months. But what's happening to the stock? It's going way up. In fact, it more than tripled in value while the RSI was giving us overbought readings. So a stock can remain overbought for as long as it wants, as long as people are buying shares of the stock. It's simple supply and demand. The stock only needs buyers to come in to drive the share price up. And it's kind of like any other market, the housing market, right? Markets tend to overextend themselves, so they'll stay overbought or oversold for longer than indicators tell us that they really are. Here's another example. This is Best Buy. So looking at the RSI indicator, it was actually relatively elevated for the period of April through October, right? So it's bumping up against the overbought signal. And then in July through August, way overbought. It's right around 90. Okay, what's happening to the shares? They keep going up. Once again, misleading information. One more example. This is Amazon. And you'll often see this on these types of stocks, right? There's a lot of volume in the shares, very liquid, a lot of buyers and sellers. And the RSI is telling, well, the stock's overbought. Yet it goes from around $2,400 a share to over $3,500 a share in just a matter of months. And the RSI never actually went down and told us it was oversold, but it kept telling us it was overbought. So, like many other indicators, they have pros and cons, right? There are advantages and disadvantages. And the RSI has some advantages to it, but it also has some significant disadvantages. But there's good news. There are other ways to gauge relative strength, because the principle of relative strength, and I think what Jay Wilder's intention was to develop something that really tells us whether something is relatively strong or relatively weak. Because in that there's value. But I think he did it incorrectly. And I'm going to tell you why. But we're going to look at a twist on the traditional RSI. And this is where that why comes in. So recall what I started out saying. The relative strength index, and it's interesting they call it relative, because the relativity is to its own price. It's to nothing else. It's basically comparing its current price to its past price. So let's pause for just a second and think about what that means. If a stock is going up, then its price is higher than it was in the past. So wouldn't it make sense that on a relative basis, it's performing strongly compared to past price, and the RSI is going to go up? That's really all it's telling us. It's not telling us that it's performing strongly compared to anything else, just to its past price. We don't need the RSI indicator to know that. We can look at a basic candlestick chart and look at the past price. Is it lower? Is it higher? We don't need the RSI to tell us that, but that's what it's telling us. So what we're going to do is we're going to look at an alternative to comparing a security to itself, which is what by the way, almost every indicator does that. It just compares itself to itself. And think about that for a second. How is it valuable to compare yourself to yourself? Doesn't make sense. So this is where the twist comes in. So this is, again, a chart of Amazon. Notice that, and I'm going to explain what the green and red means, but notice how early May, the stock is in a strong uptrend, right? And then notice that come late October, early November, that uptrend ends and the stock starts moving in a sideways channel. So the stock was performing strongly from roughly late April, early May through mid-September to early October, and then it starts moving in a sideways channel. So if we were going to buy shares of Amazon, we'd want to buy them late, let's say late April, early May, and then when the stock starts to move sideways, so the relative strength is no longer strong, it doesn't really make sense to buy shares. Maybe we use a different strategy. But this is a different way to interpret the strength of a stock. So when the histogram's green, it's telling us the stock is relatively strong, but not to itself. I'll explain that. And when it's red, it's telling us it's relatively weak. Again, not to itself. So that leads us to problem number 2. The relative strength indicator only measures the current strength of a stock relative to its past price. So naturally, when the stock goes up, the RSI is going to become overbought. When it goes down, it's going to become oversold. Now, how am I supposed to trade off that? It's very difficult. A lot of people get caught in that. So to be clear, I'm not saying the RSI is a terrible indicator. It can be valuable if you use it in the right way with the right combination of methodologies. But inherently, it's not giving us very good information. Okay? So there's a better way. Rather than compare the price of the asset and the strength of the asset to itself, why don't we compare it to a top performing index or sector and select a stock that is outperforming it? That's true relativity, because then we're comparing the price of the asset we're looking at trading to something else that is trading, in a strong directional move. So if, let's say, energy is outperforming the S&P, all the major indices, the NASDAQ, the Russell, the S&P, it's going way up. Do we want to trade a stock that's in the S&P or the NASDAQ or the Russell? Maybe, but we actually really want to find a stock in the energy sector and figure out which of those stocks is outperforming that sector. Because then we already know the sector is performing strongly. And we found the needle in the haystack. So I'm going to show you how to find the needle in the haystack. And this 1 degree difference can take a losing system and give it the steam that can spot the next stock that's ready to explode. So we've been using this methodology for a long time. We have taught our members this methodology. We give them stocks that meet all the criteria, and they're blown away. They can't believe that they're seeing these opportunities that are so easily missed, because there's thousands and thousands of stocks out there. They're not easy to find. But I'm here to make it, help make it easier for you to find these outperformers. So when a stock, starts to go up and outperform a major index or industry or sector, it often goes on to make a big move up. So when you see, some of these stocks break out of a channel, or a correction, or a full-on, sell-off, and you see them really take off, I'm willing to bet that if you applied the relative strength formula I'm going to show you, it would have spotted that stock. It's a bold statement, but I challenge anybody to do that, because it takes a lot of, obviously, it's a supply and demand curve, so it takes a lot of demand to drive a security's price up. And on a relative basis, the ones that really go up a lot are the ones that are outperforming major benchmark indices or sectors or industries. So that's the key. It's to identify stocks that shift from underperforming to overperforming relative to a benchmark index or sector. And then once we identify these, they can really be the golden ticket to beating the market. So if you want to outperform the market, which over the long term already performs well, right? We have bear markets, we have sell-offs, we have crashes, black swan events, but ultimately, in the long run, the market goes up. And if you think about that for a second, okay, how many traders and investors out there can say the same thing? How many of them are just gradually and consistently seeing their account go up and up and up year after year? Unfortunately, it's the opposite, right? Most retail traders blow out their accounts. It's a high percentage. So even in bear, and I'm gonna share some bear market examples from this year with you and how effective this is. But just to use the cliche from Jim Cramer, there's always a bull market somewhere, right? So even when we're in a bear market, relative strength can help us identify opportunities that outperform the broader markets. And I'll share some examples, actual real-world examples with you. So even in the worst market conditions, there are stocks that are going up, right? So even in this recent sell-off we've been in, energy has been a top-performing sector. So look at the energy stocks, look at the energy sector, right? It's been going up. So that's how we can spot these. So let's start to look at a comparison between the old RSI and what I call the new RSI, or the new and improved version. All right, so this, again, is a chart of Tesla. And you'll notice that late September, something interesting happened. So the RSI is trending up. It didn't quite hit 70 in the overbought territory, but it was approaching it, right? Telling us the stock's actually not doing a lot, right? It's kind of trending sideways, August, September. But eventually the RSI moves into overbought territory in October, right? So it tells us the stock's overbought, right? The shares, though, keep going up. And the indicator, the old indicator, the RSI indicator, is giving us misleading information. Same thing in December and January. Yet, the method I'm going to reveal to you is telling us the stock is not overbought. It's actually performing very strongly on a relative basis. And in this case, and at this period of time, the S&P 500 was in a very strong uptrend. Right? So what we're doing is we're comparing Tesla, its share performance, to the S&P 500. Right? So right there, around the third week of September, the stock starts to take off. And it went up over 1,800% by early February of the next year. Here's another example. So this is Teradata, TDC. So the stock wasn't really doing a whole lot. It was trading at a relatively low price in October, November, December, kind of in a channel moving sideways from around 18 bucks a share to around 22.50 a share. But then in late January, the formula identified Teradata as outperforming the S&P 500. And at that time, by the way, this isn't from this year. Obviously, the markets went way down this year. But at this time, the S&P was performing really well. It was going way up. So the formula spotted TDC as an opportunity that was outperforming a benchmark index, in this case the S&P 500, that was already going way up. And within just a couple of weeks, the stock went up 125%. Pretty good timing, if you look at it. Here's another example. This is actually one, full disclosure, don't hold shares of this in my hedge fund anymore, Futu Holdings. But I use this formula to buy Futu Holdings in my hedge fund. All right, so the stock was, it's kind of cut off on the chart on the left, but it wasn't doing a whole lot. But January rolled around. It was underperforming shortly before that. But late December, early January, the formula picked up the relative strength of Futu versus the S&P 500, which was in a strong uptrend. And then it went on to greatly outperform the S&P and the NASDAQ. Went up 380% in just a little over a month. All right, so I'm going to give you the formula now. Let's see. Lisa, you can use this for any asset class. Futures, it's a formula, and it can be applied to any asset. All right, so I'm going to give you a 4-step formula for the system. And then I'll kind of walk through each step. So step 1 is to identify a top performing industry and sector. And I'll show you how to do that here in a second. For now, I'm just giving you the steps. Right. But I'll kind of explain the reason, you know, the idea behind it. Why we obviously want to, if we're going to, you know, buy a stock or any asset, we want to buy one that's going up, right? That has the potential to go up. So that's step 1. Step 2, screen for stocks within that industry or sector. This is kind of where we start rolling up our sleeves. Like, all right, we've identified the industry or sector that is performing strongly. Now let's find the ones, the best of the best within that have potential to go up more. That's step 2. Step 3, compare the relative strength of each stock to an index or ETF that tracks that industry or sector. So let's say, you know, recently energy's been a very strong performing sector, right? So we've identified that. We then start looking at the stocks within the industry sector or the energy sector. And we then need to figure out, is it performing even more strongly than the whole basket of energy securities? That's where step 4 comes in. Select a stock that's changing from underperforming to overperforming. And we need to do that with a formula. Okay, so here's the formula. And I'll kind of explain it. It looks really super complex. It's not really that complex, but I'll explain the basics behind it. So we're really only using 2 data points. The stock price, which is data point number 1. And that's, I'm going to say stock price. It's the price of whatever you're going to trade, right? So if it's a futures contract or a Forex pair, it's whatever we're looking at trading, we're calling that the stock price. So that's data point 1. Data point 2 is the reference price. So remember, this is relativity, right? We're looking at relative strength, not to the past price of the stock or the security we're trading, relative to something else that is performing strongly. That's data point 2. So as far as the logic, if the stock price, again, data point 1, is greater than 0 and the reference price is greater than 0, which they should be, right? You don't want to be trading something that's, you know, doesn't have a value to it. We're going to get a log value. And the log value is basically the stock price divided by the reference price. So we're just taking data point 1, dividing it by data point 2. Relative strength, so we're looking at relativity now, is the average of the log value. So again, that's just data point 1 divided by data point 2 minus the length of the log value and the EMA length And those are the inputs that you see at the bottom. So the length that we use is 90 days. So we use a 90-day look-back period. And we use a 3-period EMA for the EMA length. And then we multiply that by 100. And you'll get a number. And if that number is positive, it's going to tell us that data point 1, our price of the security we're looking at trading, is outperforming data point 2, the one that we're comparing it to. Right? So again, it looks kind of complex, but it's really, pretty simple. So we're going to kind of back up for a second here. How do we find the top performing sectors? Well, there's a lot of ways we could find that out. This is probably one of the easier ways to find it. It's a free website. Well, at least for the purposes that we're using it for, it's free. We don't have any affiliation with this website, but it's a great resource if you've never tried it or used any of the resources. It's great. I think they do have paid subscriptions. You don't need them for this purpose. You can get all this information for free. finviz.com. Okay, so if you go to finviz.com, you go to the Groups tab, it's going to take you to a screen that shows you relative performance of various industries or sectors. You can sort it by different metrics, different things. I just use the default. So when you go to that page, it's defaulted. By the way, this is not a current snapshot of the performance of the industries and sectors right now. So don't look at this and think, oh, industrials is really on a tear. I'm going to go buy an industrial stock. This is not current, just for demonstration purposes. But what it's going to do is it's going to break it down by periods. So you'll see that it shows us the one. It actually, I think, goes down to a day, but we're really just looking at 1 week, 1 month, 3 month, and 6 month relative performance. But particularly 1 week, 1 month, and 3 month. What we want to find is an industry or sector that ranks within the top 3 and is positive across these different time frames. All right, so you'll notice that industrials, number 1 on the 1 week relative performance. So it's outperforming the S&P by almost 4%, almost 4.5% over the last month, almost 12% over the past quarter, almost 30% over the past 6 months. That's a strong performer. It's beating the S&P. That sector is beating the S&P, right? Across all of these different time horizons. So our work's done for us there. We with on a simple snapshot, see what the top performing industry or sector is across multiple time periods. So our next step, remember that we have the 4-step formula, is then to start looking within that industry or sector and then applying the formula to securities within the industry or sector. So this is kind of a really honed in way to do this. Again, Lisa had asked, could we do this with something else? Yes, you can. If you wanted to do this on the, E-mini S&P futures, the ES, you could apply it to another major index like the NASDAQ. Like if the NASDAQ's going way up, then you can compare that and apply the formula to the E-mini S&Ps relative to the NASDAQ. So if we just use industrials and we look within the basket of securities, and there's hundreds and hundreds of them within the industrial sector, and apply the formula, we see that right around the beginning of the 3rd week of July, it started to outperform. So prior to that, June, July, early July, it was underperforming the industrial sector. Right? And, oh, by the way, because this question may come up, I just use an ETF generally that tracks the industry or sector. Like for energy, you could use the XLE. typically just find an ETF that tracks that. There's an ETF for everything, right? So just find one that tracks that industry or sector, and you can compare it to the ETF. So you'll notice our Builders First Source was outperforming the industrial sector. And the stock went on to make 113%. Actually, continued to go way up, but within a relatively short period of time, went up over 100%, more than double. This is another one example. So this is Deere, DE. Again, underperforming. It was actually still kind of going up, just in a slight uptrend in June, July. But then again, around the third week of July, it started to actually outperform the industrial sector, which was already a top performer over the past 1 week, 1 month, 3 months, and 6 months. And the stock takes off and goes up 122%. So it's trading around 160 bucks a share, went up to almost 400 a share. So there's many examples of this, but there's another step to the system. So I want to show you this because, identifying these opportunities, okay, great. You got one, you found it, you maybe place a trade on it, then what do you do? So I have a 2-step profit target system. So target 1 is to set a 5 to 10% initial profit target on the first half of the position. So a lot of these opportunities, and we looked at some examples, could go way up, but they're not all going to do that. And some, won't go up at all. Not every trade is going to be a winner, but a lot of them have the potential to go up a lot. So in my research, and we've been sending these opportunities to our members for a long time, a big chunk of them go on to make at least a 5% move in a short period of time. So based on historical experience, we find that to be a good initial profit target. And you may want to just take full profits at that price level. It's obviously totally up to you, your decision. But since there are enough of these opportunities that go on to make much higher double-digit or even triple-digit returns. Shoot, I think we looked at one just at the beginning that made a quadruple-digit return. That you can also use a scaling out method with this strategy. So if you set an initial profit target, let's say at 5%, let's say you buy 500 shares of the security, close 250, and then keep the other 250 open and manage that with a 10% trailing stop on the second half of the position. So the ones that do go on to make big moves, it allows us to potentially capture that when it happens. So that's our profit-taking method, right? That's for getting out. Stop loss method is up to your risk tolerance. So I usually use a support level or a candlestick pattern or a combination of the two, or a change in the relative strength of the security where it's no longer overperforming as a stop loss. So again, kind of up to you, and obviously your risk tolerance and your account size. So number of shares that you trade or number of contracts, if you're trading futures or Forex, up to you, obviously, based on your risk tolerance and your account size. So you would just adjust that based on those things. So I said we wouldn't talk a whole lot about options, but we do have a lot of our members trade options. We're a big options trading firm and do a lot of education around options trading. So I thought this would be some value if you guys trade options, because a lot of our members do apply the relative strength system to options, because it has a very nice timing component to it, and it has a very nice, basically, if you're trading directional option strategies like buying calls, selling puts, vertical call spreads, bull put spreads, etc., you kind of be pretty precise with your timing, right? There's a time critical component to a lot of these strategies where even if the security ends up moving in your anticipated direction, if it doesn't do it fast enough or with a great enough magnitude, then the options position loses money, even though the stock went in the anticipated direction. So it can be a useful tool for these directional option strategies. And so our members, a lot of our members do that, particularly because if you purely buy an option like a call or a put, depending on other variables like implied volatility and other variables, the option premium can double with only a 5% move in the stock. And that's also part of the rationale behind placing a 5% up initial profit target, for profit target number 1. So we'll look at a quick example. This is Apollo, APO. All right, so around mid-April, this is not this year, but mid-April of the previous year, the stock was underperforming. You can see it was pretty much hovering around 28 bucks, moving sideways. Applied the relative strength formula that I shared with you to the stock versus the S&P, because the S&P was on a tear, going way up. Stock started to outperform it, right? And you can see that the shares started to move up. So how would we play that with options? Well, it was on April 16th that the relative strength formula spotted this opportunity. So again, Apollo was outperforming the S&P 500, which was already in a strong uptrend. And that day it closed at $29.66 a share. So that was on April 16th when the system identified this opportunity. So one way to play this with options is to buy an at-the-money strike call. At the time, those were trading for $1.70 per contract. This is a screenshot from my brokerage account of that call option. So for the example, we'll just use 10 contracts of Apollo with a September 20th expiration. So going out, what, 4 or 5 months to give this thing time to play out. Right? $1.70. So 10 contracts, that would be an investment of $1,700 before any commissions or fees. So as we saw in the chart, the stock, the relative strength formula did a pretty nice job at timing that up move in the stock. It was outperforming the S&P. The S&P was going up. And only 6 days later, the stock was trading up 5%. So it made that 5% move the initial profit target. It resulted in nearly 100% move in the option. So those September 20th 30 strike calls, just 6 days later, almost doubled, $1,650 was the profit, open profit on a purchase of those 10 contracts of those 30 strike calls. So you can actually also apply the profit target formula to this, to options. So one option is just to close the entire position, all 10 contracts. But another way is to close half the contracts. So we'd keep, if we were trading 10, we'd keep 5 open, close 5 of them, book profits on 5 of them, and keep the others open because we've got a lot more time till expiration and more time for the stock to run up. And as long as the relative strength formula is telling us the stock is outperforming the S&P, and as long as the S&P is still going up, it might make sense. In this case, Apollo continued to move up. The remaining 5 contracts picked up an extra $4,225. So with the scaling out method, total of 10 contracts exited by September 20th would have resulted in a gain of $5,050 on a $1,700 investment. So that's a 297% ROI. Just applying this formula, buying straight call options on this particular stock. So you can see why a lot of our members apply this and use our research for options. If you trade options, it's a great timing tool to apply to option strategies. So now you know that when a stock gains that extra 1 degree and begins to outperform a top-performing index or sector, it starts to boil, and it often results in explosive moves to the upside. Not every time, be fair. Not everyone is going to, go up double or triple digits, and some of them will go down. I'm going to share some performance with you here in a second. So I've revealed my 4-step process for identifying these opportunities. It does take a lot of time and work to sift through thousands of stocks every week to find the very best. We understand that because I actually do it. I spend hours and hours every week doing this. I love it, but it's a lot of work. So I've given you everything you need, and you can do this on your own, absolutely. And that's our hope and goal, is for all of our members to be able to do this on their own. But also realize that not everybody has the time to do it. So we are offering to give you these recommendations without you having to do all the legwork. So we send them out on average about 5 to 10 per week, depending on market conditions. Sometimes there's more, sometimes there's less. And we also send out text alerts for every one of them. And the nice thing is they come out after market hours. So we run the research, but it's not confirmed until the market. We base it on closing prices, so it's not confirmed until the market closes. So if the market's closed, and we can run the research on all of these, then we pick the best ones and we send them out to you. And the reason I selected this strategy for you guys, for Stephen's group, is I think it works really well because personally I use it. A lot of our members use it with other methodologies. So other indicators or other systems, particularly candlestick patterns, can be a great tool to use with the relative strength picks. So just like any other methodology that I use in my own personal trading account or my hedge fund, I seldom use just one approach. So I typically combine approaches. So you can certainly take these picks. We'll do the legwork for you, send them to you, and then you can apply other methodologies that maybe you're already using that are working well to help hone in on these types of opportunities. So again, we send these out every week to our members, right to your inbox. We, again, do it after hours, so you don't have to sit and watch your computer for them during market hours. And we also send them out by priority text if you prefer to receive them that way. They come with easy to read instructions, so you get the profit target levels, kind of go through everything you get with it. And on average, about 15 to 20 opportunities per month. So probably more than most people are gonna, can trade. There's a lot of them that we, send out, more than most people would likely trade. But of course, you can decide on your position sizing and everything, your risk tolerance, based on your risk tolerance and your account size and those things. So what you get the ticker symbol for every stock. So we do all the legwork. We figure out the top performers, the industries, the sectors. We apply the formula to all the securities within those, and we look for opportunities that meet all the criteria, and then whittle them down to the best that we can find. And we send those out with the ticker symbol, company name, price, profit target 1, profit target 2, and our analysis of why the stock is expected to outperform. So you get really everything you need to act on these opportunities if you choose to do so. So here's some examples of some recent ones. We always get asked, well, share some that you actually sent out to your members. So here's some examples. XPEV, we sent out to our members. I believe this one was last year. Went up 8% in the very first day. Vail went up 11% in the first 4 days. DocuSign went up 12% in the very first day. And he's out the day before you would buy the shares. So in the very next day, from open to close, X went up, U.S. Steel, 16% in a single day. TECL, 25% in 12 days. SGH, 31% in 5 days. And by the way, here's some examples of, so it'd be easy for me to cherry pick examples. We send a lot of these alerts out to, for easy market conditions, right? Well, hey, Jeff, we've been in this bull market. Of course, everything is going up. So here, these are some that were during 2022 bear market. So the market was tanking. Okay, the market was tanking. MCHP our formula spotted it, went up 15% in 14 days. ESI, market was tanking back in early March. Formula spotted this, went up 9% in 14 days. Again, market was tanking. SGFY went up 13% in 7 days. Actually, this one, a lot of these went up a lot more. Let's even look at a chart on this last one, SGFY. Let me just show you on a chart so you guys can see my chart. SGFY. So that one came out March 9th, that alert. Oops, typed it in correctly. All right, so we issued this alert right here. So it made, the day after this went up, or this alert went out, it made a big move up, right? So it made almost about a 3-point move up within a couple weeks. It did have a pullback into support, but currently the stock, it's hit a high of 29.88 since we sent the alert out, and it's currently closed as of today, August 25th at 28.30 a share. So again, when we sent this out, you could have bought this stock at, so it would have been, we sent the alert out March 9th. March 10th, you could have bought it at 16.59. So it almost was a double. But nice move. And this is why we use a 5% profit target, right? Especially if you're more of a short-term trader. So again, that was 2022, right? Market was tanking. There's always a bull market somewhere. All right, so we put a package together, just a special for Steven's group. So I'm going to share with you what we're offering and how you can get access to our research. So we provide 12 months of our relative strength signal service. No contracts. You can stay with us as long as you want, cancel anytime. Normally a year of the relative strength signals retails for $14.99. We're also providing priority text alerts. So if you want to receive all of these recommendations via text, we're also going to add that in. Normally our text alert services are $299 retail value. We're throwing that into the package as well. We're also going to give you access to our exclusive members only Facebook group. So we have around 900 members who also trade similar strategies, including the relative strength, that you can interact with and share ideas with and ask questions and things. And we moderate that. So if you have questions for us, you can send us a question. We're happy to ask that. We're also going to throw in training. So my goal was to give you some good training tonight, but we only have an hour roughly together, so I can only give you limited training. We've got hours and hours and hours and hours more. So we're going to throw in some special training for options, equities, Forex. It's over a 9-hour course. You can watch it at your leisure, and we also teach trade adjustments. So you get that. It retails at $900. Again, no day trading necessary. We send these all out after market hours. You'll get on average about 15 to 20 per month, again, depending on market conditions, sometimes more, sometimes less. So I hope you guys decide to continue with me and take advantage of this research. You get this all spoon-fed to you, so you get all hand-delivered, but we still are here to help you learn it. So if you want to learn to do this on your own, we're here for that too. And so that's where our professional trading series comes in. You get full access to our online courses. And I'm also going to throw in an ebook that I think really complements this strategy. This particular ebook, this is my latest book, is a money management book. So it teaches you some really cool money management techniques that can help you mitigate risk in trades, and even in some cases eliminate risk in a trade. And I go through all of how to do that, and I think it's a great complement to the relative strength strategy, or really any strategy you're using. So we're throwing that in as well. We normally sell that for $97. So over $3,500 retail value on this. So this is, if you were to buy all of this from us on our website, what all of this would cost. But we're throwing out, because you're part of Steven's group, I think it's way more than 84% off, actually. That's a mistake. It's only $49 a month. Again, no No contracts, no commitments, and I'm going to throw in a guarantee too. So if you want to try it out, see what our alerts are all about, altostrading.com/RS49. This is not a marketing ploy, I promise you. We do these events, periodically throughout the year, and we limit our memberships. And people are like, why are you limiting your membership? Why wouldn't you take unlimited number of people? Well, yeah, that would be nice, but we're not going to sacrifice service for money. So this is not, again, this is actually serious. When the 25 seats are gone and you try to go to the page, you won't be able to buy it. And the reason is that we can't take on 100 or 200 or 300 members all at once. It's too much for our support team to handle, and I'm also gonna be here to try to help you guys get comfortable with the system and answer questions and things. And so that wouldn't be possible with that many people coming on all at one time. So we do limit it 25 seats. Once you join, you're automatically going to be added to our members list, and you'll get directed to the Trade Alert membership registration page. Once you register, you're going to receive a confirmation email. Give it a few hours, and it'll confirm your access. And then you'll get exclusive access to the members-only portal. So you can find the alerts there. Again, we send them out by email and text as well, but you can access everything in the members portal. And you're going to get your very first alert this week. It's actually already there. It was sent out last night. So there's already, I think, 4 or 5 picks that we researched and sent out last night. Okay. They're all waiting there. And then you get the bonuses, the professional trading series, and my latest ebook, How to Create Risk-Free Trades. And I mentioned I'm going to throw in a guarantee. So we back everything with performance. So if you don't at least make your membership fee back in 90 days, which I hope you would do. So at that point, if you stay with us for 3 months, $49 for 3 months, I'm hoping you can make that back. I'm hoping you do way, way better. That's my goal for everybody here. But we're going to give you an extra year of signal on the house. So $1,499 value, and we'll give you a refund. So we want you to be successful. We really, really do. So we have that 90-day guarantee. Our office is closed right now. So our main office is based in Atlanta. Our reps will be back in tomorrow morning. So if you have questions, and I'll spend a few minutes here to answer any questions, but if you have questions, you can email us support@altostrading.com or give us a call 800-895-9348. And if you have questions, we're happy to answer those when the office opens back up tomorrow. Okay. Well, I hope you guys got a lot out of that. I hope you enjoyed. I have not been monitoring the chat, so Stephen, I don't know if there are any questions that you want me to answer, or if you want me to kind of scroll through and see what came through. Or maybe Becky. I'm not sure who's on the other end. Or Jim.
Yeah, I don't know whether these, you've got Mohammed who's asking, do you apply this methodology to shorting stocks, put options, etc.?
Yeah, good question, Mohammed. Theoretically, you could, but you'd have to change the formula, because then you obviously want to look for negative, or at least change the interpretation of the formula. You want to look for negative performing. So theoretically, it's possible. I've never done it. But yeah, theoretically, you just kind of have to flip everything over and do it opposite.
And Roy is saying, do you have approximate win-loss ratio? Let's see what you got here.
I always hate to kind of quote something because without looking at the current sheet, but it's, I mean, when we first launched, so we launched this, I think back in April, was it April of last year? So a little over a year ago. Like the first 35 recommendations we sent out, 34 of them hit their initial profit target. Last week, we sent 5 alerts out. 4 of them have already hit their profit target. So there's losers, absolutely, but the win-loss ratio is pretty dang good. And I consider a win hitting that initial 5% profit target. I can't show you last week's picks, Don. Sorry, because they're still open. Unfortunately, wouldn't be fair to the paying members.
Lisa's asking, what is the price for 3 months?
Well, it's actually a monthly, so it's just $49 a month. There's no commitment or contract, so you could try them out for a month, and if you decide it's not for you, then you can cancel. So it's just $49 a month. No commitments, no contracts. And in your grandfather, and at that's not the normal price of the service. So again, it's normally $1,499 for the year. So you're grandfathered into the $49 a month as long as you're a member. Otherwise, it's basically you'd have to pay the $14.99 a year for the whole year of the service.
All right, Rob's asking, why did the green bars of Tesla versus RSP keep going up when Tesla had a big drop in price, in your example?
Good question, Rob. Because Tesla was still trading higher than the price that it was when the relative strength formula spotted the outperformance of the S&P, and it was still outperforming the S&P. So that's the reason that it would still qualify as outperforming. And even though that in that particular case Tesla went way up, any stock that goes way up can then drop, right? So again, that's where the importance of using that two-step profit target system comes in. That one easily hit its 5% profit.
Don is asking, how can you show the picks from 3 weeks ago and how they did? Don, that'd probably be a expensive.
Yeah, I'm willing to do that, Don, but I actually don't have those on. I'm on a different computer. If you shoot me an email, even though some of those may still be open, I'd be willing to do that. Just email us support@altostrading.com and I'll share those with you. Because they're actually, I think, four of the 5 are have gone up over 5%.
Okay. Michael is asking, when it is a loser, is there a percentage loss that you limit?
Good question, Michael. Again, I don't like to use arbitrary percentages. I prefer to look for like a support level and then adjust my position size accordingly. So, based on my risk tolerance. So that's really the way that, professional institutional traders and hedge fund managers manage position sizing and risk. They don't say, well, I'm only, I'm willing to risk this amount. They first look at a logical level to place a stop at, which for me would be like a support level. I know, Stephen uses the T line. So you want to use some logical technical level and then place a stop below that level and then determine the point size between your entry and your stop and your risk tolerance. Say you're willing to risk, 2% of your account on any individual trade, and then use that to calculate your position size. That's kind of the step process for determining how to do that. If you wanted to just use an arbitrary percentage stop loss, we're, again, targeting 5% minimum on each one of these recommendations. And many of them go on to do much more than that. So it probably wouldn't be wise to risk more than 5% of the stock's price, not of your account, of the stock's price. But again, it's an individual decision, something that I think everyone should decide on their own based on their risk tolerance.
Okay.
Oh, Michael's for options. Yeah. Yeah, for options, I actually I don't use stop losses in options. So I put my full allocation, or I'll scale in often. But whatever my risk, capital is, I'll allocate either through a scale in or a full allocation up front. And I either hit my profit target or not. So I'm not using stop losses because the volatility, and then you can also get caught in spread widening with options as well. Takes takes out way too many trades on a stop than should have been that would have otherwise gone through and become successful. So I just allocate my risk tolerance to one trade and go that way.
All right, just a couple more. I guess Rob is asking, in managing your hedge fund, what was your annual return since inception? And
yeah, so we had positive return. So we launched in early 2020 and had positive returns in both years, 2020 and 2021, and we're also up this year. But I can't solicit my hedge fund on here and start sharing performance, so you'd have to reach out to us, send us an email, and I can talk to you about that.
Michael, you send text alerts to get out of a trade when it's going the wrong way.
No, so we give you everything up front. So these are kind of more recommendations with profit target levels. So we don't manage the trade for you. That would be up to you.
All right, and Wayne, I guess it's Wayne saying, is this only for stocks? How does it apply to options? Probably apply the same way.
So yeah, again, that's actually a great question. So I forgot to mention that most of these, the picks that we come up with in our research are optionable. I would say well over 90% are optionable stocks. Not all of them will be, but the vast majority will be optionable stocks. So if you trade options, you can certainly trade, like I mentioned, a lot of our members trade options around these recommendations, but we don't provide an options alert. So there might be, an array of option strategies you could structure around one of these recommendations, but we just send out the stock alert. So it would be up to you, to structure an option strategy around that. We do offer other option strategies, alerts on options and things, but those are different services. So in this particular case, this is just for equities, and we also do ETFs as well.
All right, good stuff, Jeff. Thank you for the information tonight. Everybody,
thanks so much.
Take a look at it.
It's always great to be
here. For the price, you're getting a lot of information, and Jeff's reputation has been extremely good. So this is a strategy that you would like to dig into. Again, for the money, you're getting a heck of a lot more than your money is worth. Yeah, so Lisa's saying for $49, it's worth a try. There you go. All right, thank you, Jeff. This was a lot of good stuff.
Thanks so much, Stephen. It's always a pleasure to be here. I really appreciate it. And thanks to all of you. I hope you guys have a great rest of the night and a great trading day tomorrow. Watch out for that Jerome Powell speech in the morning.
That's
10 a.m. Eastern.
All right, everybody. Have a good evening. We'll see you bright and early in the chat rooms.